Então a primeira palestra do dia já vai começar e vai tratar justamente das expectativas futuras em relação à bolsa em nível mundial. É um conteúdo gravado que você vai acompanhar agora junto com o Fernando Ferreira, que vai fazer a condução do papo com a Kate Moore, que é gestora da equipe de alocação global da BlackRock. Ela vai ser entrevistada pelo Ferreirinha, que é o estrategista-chefe da XP, e vocês podem acompanhar agora. Fique ligado que está começando agora o Melhores da Bolsa.
Boa noite, pessoal. Eu sou Fernando Ferreira, estrategista-chefe aqui na XP Investimentos e head do time de análise. Eu tenho a honra agora de receber a Kate Moore, que ela é gestora da BlackRock e também estrategista de alocação global da BlackRock, que é a maior gestora do mundo, né? A BlackRock tem mais de 7 trilhões de dólares sob gestão. E eu conheço a Kate de longa data, já tive a oportunidade de trabalhar com ela no passado, então vai ser um prazer para mim, uma honra rever e falar com ela de novo e entender um pouquinho mais do que está acontecendo nos mercados, né? Acho que a gente viu muita volatilidade esse ano, então vai ser bem interessante a gente escutar qual a perspectiva da maior gestora do mundo, né, nesse mercado que a gente está vendo uma volatilidade enorme esse ano. Kate, it's great to have you here with us. Thank you so much for joining us. It's a pleasure to see you again.
Yeah, it's wonderful to see you as well.
Great. I mean, as to start, right, and help investors here in our chat, we've seen a lot of volatility this year, right, and specifically this month in November, we're seeing the best performance, right, in equity markets in the last 30 years, as I was reading this morning. I mean, how do you explain, right, such a strong, very strong performance, and how do you feel investors should be positioned going forward, right? Do you think people need to be a little bit cautious, or are you still optimistic even after this big rally that we've seen recently?
Yeah, so I think there are a couple points to get into on your question. The first is around volatility. Now, Fernando, you and I have lived longer than some of our young colleagues, for example, in terms of markets. And while this level of volatility has been higher than in the previous years, and particularly after the financial crisis, where monetary policy and liquidity really helped to dampen both economic and market volatility. This level of volatility is not that unusual from a longer term perspective. And actually, for a lot of active investors and for a lot of tactical investors, it was an opportunity when the market was selling off, or even when it got a little overpriced and ahead of itself sometimes, to sort of move around portfolios. So the volatility doesn't bother me in the slightest. But you made a great point. I mean, this month we've had phenomenal performance for equity markets. Much of that has been driven by a rotation in the market more recently, as people have become more excited about vaccines, the end of the pandemic, and a return to more normal economic activity. And so you've seen a lot of churn in the market over the last few weeks, and expectations that will return to something that's closer to normal economic activity in 2021. So there's also this other question which you brought up, which is because the markets have done so well this year, in fact, much better than many people had expected, it's natural to ask, has all of the good news been priced in? And this is where I am still very bullish for 2021 on equities, on US equities, as well as emerging market equities. I think we are in a place where companies have shown how resilient they are. We've had a very difficult year, and yet second quarter and now more recently third quarter earnings have been much stronger than people expected. Companies have controlled their costs, even in a very tough revenue environment, and they have produced profits. So maybe not as great as we had last year, but I think we have this incredible example now of corporate resilience. And against a backdrop of more challenging returns in other asset classes, I think you stay long equities and continue to invest in the market.
Very interesting, Kate. And the U.S. elections, right, it seems to be ages ago, and it was just last month, right? When we look historically, we see that a Democratic president with a divided Congress historically has been the best scenario for equity markets, right? Is that how you see equity markets performing the next 4 years, or you think that politics doesn't matter as much for the markets?
Yeah, so let me say that the last few months, I'd say for most of the fall through the election and the following few weeks after the election, was a period of very little sleep for many of us in the US, and particularly those of us that are connected to DC and follow policy very closely. I am very excited that we're going to be able to move forward regardless of the composition of the government and actually just return to some sort of normalcy in the political environment. You make a good point, though. Historically, a divided government was good for equities and risk assets in general. The idea being that, when there isn't a single agreement, there's fewer policy changes, fewer regulations, fewer changes in legislation. And that's generally a better environment for corporates. They don't have to adapt any of their business to changing policy, then they can just continue with business as usual and stay focused on their clients, their customers, and their product. But this is a really different year. And so divided government, or 2021 will be a very different year. Divided government is going to be a little bit challenged. While at one sort of hand, you would say, well, we're not going to get as many radical policy changes, perhaps, as we might have gotten from some of the progressive parts of the Democratic Party. On the other hand, we need Republicans and Democrats to really work together when it comes to fiscal stimulus and supporting the economy. We're still 6 months or more from the average healthy adult getting a vaccine in the US and elsewhere. And until then, a lot of businesses are going to suffer. Activity is going to remain really muted. And I really want to see, constructive dialogue and nonpartisan policy decision making. Now, I'm putting a decent probability that we'll actually get some of that, but the magnitude of the fiscal stimulus in the first part of 2021 is probably less than I would have hoped or expected a few months ago, given the political discord. But nevertheless, we do know that both Republicans and Democrats don't want to be left with the stain of not delivering for the American people and also for small and medium-sized businesses.
That's great. Thanks, Kate. And also one of the reasons why the markets have done so well this year, right, despite a huge economic shock in the pandemic, has been the huge amount of stimulus that we saw, right, both monetary and fiscal stimulus, over $20 trillion globally, right, this year. And we're seeing talks, right, about a new round of stimulus in Europe, a new round of stimulus in the US. In your view, and supporting your bullish, right, view on equities, how important are those new stimulus in your view? Do you think they're needed in order to continue to sustain the markets into 2021?
So I think the one thing that has really been very clear is that central bankers and policymakers in that sphere have committed to providing enough liquidity and enough support, asset purchases, innovating with new programs to support both the economy and the market. I don't think that's going to reverse course in 2021. In fact, our outlook at BlackRock for the liquidity environment is incredibly constructive next year. Even if, say, inflation were to slightly overshoot targets of central banks, we think we'll see rates remain at or close to zero for the foreseeable future, and that central banks will continue to add to the balance sheets through asset purchases. So that's a very constructive backdrop for risk assets. One of the things that I think we had a great hope for at different parts this year was the coupling of both fiscal and monetary policy, the coordination between fiscal and monetary. For example, we've heard multiple times throughout the course of this year from Fed Chair Jay Powell that fiscal needs to then take the baton and do the next leg of work. In a divided government scenario in the US, or if we have slightly better economic activity in other parts of the world, so governments don't feel as motivated to spend as much as they might have a couple months ago, we may not have that coupling as close as we might have expected a few months ago. That said, it's very hard to see how policy and liquidity won't be tailwinds for risk assets next year. Now, as we get further onto the year, economic activity normalizes, and as we can get back to kind of more normal analysis instead of sort of pandemic crisis analysis, we may see a slight different tone from both fiscal and monetary policymakers. But right now, I think it's all steam, or all engines going ahead.
And one of the big discussions I see, right, especially on Twitter, is how expensive equity market seems to be, right? A lot of people talk about that valuations are too stretched, and equity prices can go any further higher, right? And I remember a discussion that you and I were having several years ago, and we were discussing how expensive bonds were back then, right? And the fact that interest rates couldn't go much lower. And here we are today with $17 trillion, right, of negative yielding debt in the world. So, I mean, how do you compare, right, equity valuations with bonds, right? Because I think that's what a lot of investors, and especially asset allocators like BlackRock, that's exactly what you're looking, right? It's not just equities relative to history, but equities relative to other types of investments like fixed income, right?
Yeah, I can't repeat what you've said enough times, that there are very few investors that are just looking at one asset class in isolation. Almost all investors, for institutional investors, individual investors, my team, which is an asset allocation and global opportunities team at BlackRock, are looking at the full suite of opportunities. So when people get uncomfortable with, say, equity multiples, or they look at valuations relative to history and say, I can't buy this, they are not really taking a good look at what the rest of the opportunity set is. Bonds, in our view, offer very, very little potential for total return and positive return over coming years, given the starting yields. We see high valuations in private assets as well. And we see higher valuations in equity markets. But I think there's a couple interesting things to say around this. And actually, to be fair, I could probably spend an hour talking about equity valuations because I'm so passionate about this. But we've had a structural change in the way we think about valuing equity assets over the course, really, of the last 15 to 20 years, not just the last couple of years where we've had so much monetary stimulus and so much liquidity. And one of those big changes has been driven by information availability. You think about this. When we started our careers a couple decades ago, or when I started my career a couple decades ago and change, we didn't have Twitter. We didn't have third-party data sources. I didn't have satellite imagery. I didn't have credit card data. I didn't have invoicing. There was very few ways I could really, through third-party data, evaluate the opportunity, the demand and supply for an individual company. I had to kind of rely on hearing from them when they reported earnings or when they spoke at a conference. Now we have all of this visibility, and this data democratization has led us to understand risk and opportunities for different companies differently than we ever have in the past. So I think we can, live with a higher multiple because we have better information. The second part of it, of course, is also the liquidity environment and the monetary policy regime. That has obviously had a huge impact on cross-asset valuations, on bond yields, on the equity risk premium. And as I was mentioning in my earlier comments, I just don't see that reversing. The policy stimulus and the policy support will remain squarely in place, in my view, at least through 2021, if not for much longer. So you take these two things, kind of in combination: better information, better ability to read future profitability, as well as policy support, and multiples should be much higher than they have been historically. Another piece of analysis that we just recently did, because BlackRock held its investor summit, we gather our senior portfolio managers and investors twice a year for a big debate session over a series of 3 days. This time, of course, it was virtual. And a piece of analysis one of my colleagues did was looking at which companies and industries and parts of the market really moved the most in terms of valuation throughout the course of this year. And as it turns out, those parts of the market that were really expensive in the beginning part of this year got more expensive. And the stuff that was, more discounted at the beginning of this year got cheaper. And that's largely because the stuff that was trading at premium valuations actually proved they deserved it. They generated profits, they generated earnings in a really difficult economic year. And they were in parts of the world and parts of commerce and parts of consumption that continue to grow even in a more challenging environment. So I don't really let valuations, take down my equity allocation, and I am not letting that stand in my way of investing in great business models and management teams and balance sheets.
That's great to hear. I completely agree with your views. So that's very comforting to hear as well. Now let's talk about this rotation that you talked about, right? We've seen a massive rotation on the last 30 days or so, right, into cyclicals, more value-oriented stocks, and we've seen a huge rally on energy and financials right after the three good news on the vaccine front, right? Do you think that this is a short-term correction, or do you believe it could still have legs going forward? Because this has been quite beneficial to emerging markets as well. So if you can talk briefly as well about what are your views on emerging markets, that would be great.
Yeah, I'm going to separate out these two things, sort of the rally in emerging markets and then what's happened particularly in like energy and banks, thinking about regional banks and European banks, other parts of the resource complex, et cetera, in the US and Europe. And I'm separating these two things out because I think, in that group, the rotation into some of the unloved sectors and industries, I'm not even going to call them value because frankly, some of them are not trading at cheap valuations. These are sectors and industries that are more structurally impaired and got more impaired over the course of the pandemic and the weakness in economic activity. Some of those, that this trade and this sort of momentum we've seen in that space, particularly over the last month, but over the course of the fall, has really been about short covering and about institutional investors reducing their underweights to the sectors, not necessarily taking on big, aggressive, long positions. It was neutralizing these positions. That's how we have to think about it. And I think there's maybe a little bit more room to go. These are not sectors and industries that have particularly good fundamentals. And even in an economic recovery, I think we're going to see spending in other areas of the market around technology, consumer, and healthcare, and maybe less so in terms of energy and industrials and things like that. So a wholesale rotation, I'm not really baking in, although I do have a couple, economic reopening trades in the portfolio, looking specifically at services and activities that may benefit once we actually can gather together in groups. So there's that bit. But I think what's happening in the emerging market side is, when it comes to emerging Asia in particular, an acknowledgement that emerging Asian economies and markets are much further along in the pandemic and the response to the pandemic than developed markets in the US and Europe in particular. That you've actually seen much more return to normal activity without as much needed policy response. And so there's been a real reallocation there. I think a lot of that is durable. And I think the changing sector composition of a lot of the emerging market indices towards higher growth and I think more dynamic sectors makes it particularly interesting. We are quite constructive on emerging market assets, both on the equity and the debt side as we go into 2021. Both the growth story as well as the quality story, and also really honestly, Fernando, from a portfolio diversification perspective, this is critical, which is I'd rather own some emerging market assets to diversify what I own in kind of high quality US over Europe, where we still face a lot of political and perhaps policy and structural challenges. So I think there's some rebalancing going on in that side of the portfolio. I think that has legs, and I expect to see emerging markets, both on the equity and debt side, perform very strongly in 2021.
That's great. And since you touched on Asia, right, the U.S.-China relationship and the trade war has been a huge focus, right, for investors in the last 4 years. Do you think that relationship is going to change? And if so, do you think this will be a lower risk on the horizon?
So I'm going to steal a little bit from one of my colleagues who was the former national security director under Obama and is incredibly well plugged into the geopolitical machine. And he's basically said the era of U.S.-China strategic cooperation is over, and the era of U.S.-China strategic competition is here. It's going to be here whether it was a Republican or Democratic administration. And what I think will change, over the next year and perhaps over the, Biden's term is the approach to engagement. Not that the U.S. is all of a sudden going to go easy on China because we have a Democratic president, but in fact, I would say we should not expect the Democrats to be easy on China. A tougher stance and a renegotiation of the relationship are definitely in the cards. And it's one of the few things that both Republicans and Democrats can agree on that we need to do. But, when I talk about this change in approach to engagement, I think there are a couple things. Given, first of all, the pandemic and the immediate need to support the domestic economy, and for the new administration to figure out how they're going to roll out vaccines and distribute them to 300 plus million people in the United States, for example, the focus in the first few months of the Biden administration is going to be squarely on that, dealing with the pandemic, the economic fallout, and then putting forth some more fiscal stimulus, perhaps around infrastructure and green energy, things that will generate more medium-term growth. And then, I think we'll see the administration start to take a closer look at the relationship with China, all the while trying to keep the dialogue open. I think Biden is unlikely to immediately reverse any of the phase one trade deal or any tariffs. I think his administration will need some time to kind of formulate their new views, and they want to have a plan that is clear, that is well architected, and doesn't seem as reactionary and transactional as what we experienced over the last 4 years of the Trump administration. So a change in the relationship is certainly coming, but I expect it to be more incremental and the conversation around it to be more balanced. That's a nice way. That's my nicest language around that, Fernando.
One of the themes that BlackRock has been a pioneer on, and it's been great to see, is on ESG, right, which is a very relevant topic for all investors going forward. Have you noticed any change on ESG trends, right, post the pandemic? And how do you, right, use the ESG approach when you're analyzing assets to buy, if we're talking about a company or a country or a fixed income asset, right? How do you use the ESG approach on your investment decisions?
Yeah, so maybe if we go back 18 months ago or even 2 years ago, it was sometimes frustrating for us that our European clients and European investors were so much more focused on ESG than the US. One of the incredibly positive outcomes of the pandemic has been an acceleration in focus in ESG for US clients, and which has allowed us to spend even more time and focus more energy around our analysis of sustainability and which assets, which companies, which sectors make the most sense from a long-term investment perspective. So we look at this in a number of different ways. So whether we're talking about a private investment, because we do that in our global allocation fund as well, or an equity or a credit or a bond, we put everything through the ESG ringer, if you will. We really scrutinize on environmental, social, and governance. We have a very robust team that looks specifically around governance and helps to engage with companies as well as policymakers so that we can have the best information possible. We certainly use third-party analytics when it comes to ESG and take a good look at how each of the different companies are screened. But we do recognize that sometimes in emerging markets, those ESG scores don't make as much sense. So that's why it really is incredibly important to know the asset, to know the company, to be engaged with the management team and make sure that sustainability and ESG considerations are part of their business. I think, as I said, this is one of the most positive things that has come out of the pandemic, is that more people are focused on sustainability and ESG, and that it is front and center, not the third or fourth part of an investment conversation now. It's very exciting. It's very exciting as BlackRock to be able to engage with all of these companies. It's very exciting to see this change and to see companies make changes in their operations and the way that they engage with shareholders and the way they think about their impact on society. And, as a global citizen, I feel very, very encouraged by these changes.
No, that's great. I had the pleasure to talk to Larry in July about ESG, and it's great to see, right? The amount of work and effort that BlackRock is putting around the theme. Here at XP, we're trying as well. We're pushing hard around that theme in Brazil, which we were even behind the US, I would say, right, in terms of ESG focus, and we've seen a massive change already in a couple of months. So it's great.
That's wonderful.
Yeah. Kate, we have a lot of investors that are listening to us that have just started investing in equity markets, have just started, right, to take on some risks on their portfolio, because Brazil has a history of very high interest rates, right? And investors didn't really need to take a lot of risk in the past. So what are some of the tips that you can give to those investors that are just entering the market right now, starting to take on some risk? How can they, right, have a long-term view and live with that volatility that will be, right, happening in their portfolios going forward?
So, I mean, the easy answer is, number one, to play the long game a little bit. And kind of maybe the best way to think about gaining exposure to the equity market is to have some index exposure. You certainly can do that through ETFs, and BlackRock has an amazing suite of iShares, even though I invest on the active platform. And then layering that on with more active investments and really interesting themes. This is really tied to our previous conversation around valuations, where I wouldn't advise any of the investors listening in to get overly hung up on valuations relative to history. I think the three things you have to focus on when you're investing in either an individual company or an industry is, what is the business model? What is the addressable market that business model has access to over the coming years? Is it a growth opportunity, or at best, are we talking about stability? What are the balance sheets of the companies that I'm investing in look like? In an era of very low rates, balance sheets are much healthier than they have been in the past. Interest expense is not so expensive. We actually see very little change given our monetary policy expectations. But you do want to see companies that are managing their cash appropriately, that are using debt in the right way. And so I'd say, pay attention to the balance sheet. And then the other thing that I think is really critical, especially if you're investing in individual companies, is to get to know the management team. It's not just about the ESG and sustainability stuff we were talking about a moment ago, but also about really getting to understand, how do they see the world? How do they see the competitive landscape? Are they innovators? Are they just trying to keep their place in line? Or are they doing something that's more transformational? This is an incredibly exciting time to invest right now, because there has been an acceleration of all of these interesting trends in behavior for consumers, for companies, in technology, in healthcare, and it's time to get into the fast river. So I appreciate that Brazilian investors have had this amazing return potential in the bond market for some time, but there are even more dynamic and interesting opportunities in some of the fast rivers of, as I was mentioning, technology and consumer and healthcare.
And Kate, with that, I'd like to thank you very much for participating in our panel here. It was a pleasure to see you again. Hope we can catch up soon. Again, thank you very much.
Oh, it was a pleasure to participate, and I wish we could be together in person next time.
Thank you. E é isso. Agora vocês ficam com o evento Melhores da Bolsa, com o próximo painel que vem por aí. Obrigado.
É isso aí, pessoal. Muito bom, Ferreirinha, muito bom. Esse papo foi excelente. Vamos dar uma olhadinha agora no que estão falando nas redes sociais aí do nosso evento? Conseguimos pôr na tela?